Did you know that if you steal money from someone without them knowing, that money is not included in your gross income, meaning that it's not taxable? But if you scam someone to give you money willingly, then that money will be included in your gross income. That money is taxable. However, guys, I'm not saying that you should go and steal money or go and scam people. Don't do that. Anyways, let's just check this out.
Geldenhuys, a widow who inherited her husband's estate. The deceased husband's estate included a flock of sheep. The widow did not own the sheep outright. She managed them as part of her duty to the deceased's estate. She later sold the sheep and distributed the proceeds among the heirs of the deceased. Upon the assessment, SARS argued that the sale proceeds of the sheep were amounts received by the widow during the tax year and must be included in gross income. The widow argued that the proceeds of the sale did not constitute taxable income for her, but were simply part of the estate that she had managed to liquidate for distribution. The matter was taken to the court, and the question was if the sale proceeds of the sheep accrue to or were they received by the widow as part of her income, making them subject to tax under the Income Tax Act. The court held that the proceeds from the sale of the sheep were not taxable income in the hands of the widow. Instead, they represented the distribution of capital from the deceased estate. Principle: the amount is only included in gross income by a taxpayer only if it is received by him on his own behalf, for his own benefit. MP Finance. MP Finance Group CC operated an illegal pyramid scheme that was designed to defraud investors. The intention behind this operation was primarily to appropriate investors' money for personal gain rather than to engage in legitimate business activities. This scheme involved multiple entities that ultimately went insolvent, leaving many investors with little to no returns on their investments. After the collapse of the scheme, SARS demanded that the operators pay taxes on the income generated from these illegal activities. SARS issued tax assessments for the years 2000 to 2002, amounting to approximately 500 million rand. The liquidators of MP Finance contested these assessments, arguing that the income was derived from illegal activities and should not be taxable. This led the two parties to court with a question: whether income obtained through illegal means could be included in gross income as defined by the Income Tax Act. The Supreme Court ruled that amounts taken from the pyramid scheme constituted amounts received within the meaning of gross income under tax law, regardless of their illegal origin. Principle: a bilateral receipt that is used for your own intention means it has been received by you. You intended to use it for your own benefit. Unilateral receipt doesn't mean it has been received by you, as it was never given to you in the first place. Pyott Ltd, a biscuit manufacturer, became embroiled in a tax dispute with the South African Revenue Service, SARS, primarily due to its handling of deposits received for returnable tin containers used for packaging its products. The company charged a deposit for these containers, which was refundable upon their return by customers. The core of the dispute arose when SARS classified these deposits as part of Pyott Ltd's gross income at the time they were received. The company contended that since these deposits were intended to be refunded, they should not be included in taxable income. Additionally, Pyott Ltd sought to claim deductions for the contingent liability associated with these deposits, arguing that the amount set aside for potential refunds should not be considered income. The matter escalated to the Supreme Court, where it was determined that while the deposits were indeed taxable as gross income upon receipt, the company could not deduct the contingent liabilities for potential refunds. Principal generally deposits are still received and form part of gross income. A deposit is only treated as not being received if the money is kept separately in a trust account for the benefit of the customer.